Welcome back to the Pro Ticker Podcast, everyone. It's your Wednesday morning edition with, the drill covering major financial magazine headlines and all that. Today on the deep dive, we are going to be sifting through the latest from the big financial publications, MarketWatch, Bloomberg, the Wall Street Journal, to bring you those key insights. What's really driving the markets, what's shaping your financial landscape, and all that. We got a fascinating set of articles here to unpack together, ready to get started.
Yeah, let's do it.
Okay, cool. So first up, let's tackle some interesting advice I thought coming from BlackRock. This was highlighted in a recent piece on MarketWatch.
Yeah, absolutely. So this MarketWatch article is honing in on Larry Fink's annual letter, which, carries a lot of weight in the investment world. And he's proposing a pretty significant shift in that traditional, portfolio mix that we're all used to. So instead of the old reliable 60/40 stock bond split, he's suggesting something closer to 50% in stocks, 30% bonds, and then a notable 20% allocation to what are called private assets. Now, for our listeners out there, when we talk about private assets, think things like private equity, hedge funds, private credit, and even real estate deals that aren't bought and sold on the public stock exchanges. So historically, this has really been an arena for those big institutional players and, very high net worth individuals.
Okay, so Fink is essentially saying, maybe that old reliable 60/40 split isn't really cutting it anymore, and we should be looking at this 20%, chunk going towards these private assets. But the MarketWatch article throws in a real head scratcher right away by referencing this brand new study from the National Bureau of Economic Research, the NBER, specifically looking at private equity. What did that research uncover?
What's really thought-provoking here is this NBER study found an inverse relationship between the size of a private equity fund and how well it performs later on. And their conclusion was quite direct. Larger funds do larger deals which perform worse. So think about that for a second. The very funds that have the brand recognition, the long track record of success, might actually be set up for more mediocre returns simply because they've become so big.
That's a real twist. So if you're an investor out there considering, maybe dipping your toes into these private assets,
Yeah.
like Fink is suggesting, you're immediately facing this potential catch-22,
Yeah.
right?
Well,
The
see
the
that.
established, well-known funds might actually have a performance ceiling just because of their size.
Exactly. And then the alternative is to look at smaller, more niche private equity funds. But as you can imagine, these often have much shorter histories, making it incredibly difficult to really assess whether, their early wins are a sign of future success or just a bit of luck. So it introduces a whole new layer of, due diligence and risk, especially for investors who don't have deep experience in this less transparent part of the market.
Which brings up a really interesting point when we consider BlackRock itself, right? I mean, they are obviously looking to expand their offerings in private assets to a broader investor base, potentially, including, more individual investors just like you.
Right.
If they attract a massive influx of capital into these private investment vehicles, wouldn't they almost necessarily be pushed into doing larger and larger deals, kind of creating that problem that the MBER study was highlighting?
That's a very insightful question. So, as BlackRock tries to, meet this growing demand for private assets from a wider range of investors, the sheer scale of capital they'd be managing could indeed force them into pursuing those larger transactions, and that could inadvertently land them in that very situation that the NBR study cautions against, potentially leading to lower returns for the investors in those funds. So it really raises this question about the scalability of outperformance, in the private equity space. Can you really maintain those high returns as you grow bigger and bigger?
The MarketWatch article then digs into the actual performance of some of BlackRock's existing private asset funds.
So let's look at the numbers here. What did those reveal?
So the article points to a couple of key examples for European investors. Their iShares listed private equity UCITS ETF had a 10-year annualized return of 12% through the end of last year. Now, on the surface, that sounds pretty good.
Yeah, not bad.
However, when you compare it to the S&P 500's 13.1% annualized return over the same decade, it actually underperformed.
Interesting. And what about their fund that's more focused on U.S. institutional investors?
So the BlackRock Private Investments Fund has a shorter track record, as the article notes, but over the 3 years leading up to the end of 24, it achieved an annualized return of 6.8%. Again, that falls short of the S&P 500's 8.9% return during that same period.
Now, underperforming the broad stock market isn't necessarily a red flag, right? If an asset class offers significant diversification benefits, if it zigs when the stock market zags, the RL touches on the correlation and volatility of that European private equity ETF. What did we find there? Right. This is where the diversification argument becomes a bit shaky. So the correlation between that iShares listed private equity fund and the S&P 500 over the last decade was a very high 96%.
Wow.
That essentially means they've moved almost in lockstep. What's even more interesting is that the private equity fund was actually 52% more volatile than the S&P 500 during that same period. So while the core idea of diversification is to find assets that don't move in tandem, offering a smoother overall portfolio ride, this particular listed private equity option seems to offer more bumps and not much in the way of independent movement.
Yeah, so not really providing that uncorrelated hedge that you might typically look for in alternative assets. The Market Watch piece then pivots to a potential secondary motivation behind BlackRock's kind of aggressive push into this area, referencing a 2023 study. What was the key takeaway from that research?
So this 2023 study in the Review of Financial Studies suggests that firms like BlackRock might be capitalizing on the increasing investor fascination with alternative investments as a strategic move to launch new products that come with, you guessed it, notably higher fee structures.
Right.
Think about it. A small percentage fee on a massive pool of assets can generate some pretty significant revenue.
That's a pretty lucrative equation, higher fees on a growing mountain of assets.
Yeah, exactly. And the article also brought up another academic paper that I think is relevant here. This one looked at the timing of new investment product launches.
Yeah, what was the gist of that?
So this was the Competition for Attention in the ETF Space study by Ben David and his co-authors, and they found a pattern that investment firms tend to roll out these specialized and often pricier products when investor enthusiasm is at its peak, potentially right before a market downturn.
Oh.
So the logic is to capture those investor dollars when sentiment is high and they're actively looking for, the next hot thing.
Makes sense. So
Yep.
how does all this connect to the current, buzz around private assets?
Well, what's really interesting is the MarketWatch article highlights a sustained upward trend in investor interest in private assets over the last 15 years, with that interest really picking up steam, recently. So this suggests that BlackRock's big move into private markets might not be them leading some brand new trend,
Okay.
but rather strategically positioning themselves to capitalize on an already well-established and growing investor appetite. They might be more of a sophisticated follower than a pioneering leader in this particular space.
Okay. A lot to digest there regarding BlackRock and the allure and potential pitfalls of alternative assets. Now, let's switch gears to another major set of headlines that have been dominating the financial news cycle. President Trump's upcoming tariff announcements. We've got a few sources here to pull from, MarketWatch, Bloomberg in particular.
Yeah, absolutely. So President Trump is slated to unveil new trade restrictions today, a move that his administration is sometimes referred to as Liberation Day. And the announcement is expected around 4 p.m. Eastern Time, and the White House has indicated that these new tariffs could potentially go into effect immediately.
Wow, so the concept of reciprocal tariffs has been mentioned quite a bit in the lead up to this. Can you break down what that actually means?
Sure. So the idea behind reciprocal tariffs is that the U.S. would essentially mirror the tariffs and other non-tariff barriers that other countries currently impose on goods coming from America.
Okay.
So the administration has suggested this approach might initially focus on roughly 10 to 15 trading partners that have significant trade barriers in place and also run substantial trade surpluses with the United States.
Got it.
The aim, ostensibly, is to create a more level playing field.
Okay, but it sounds like there are also rumblings of potentially broader, tariff actions as well.
Yeah, reports in the Wall Street Journal have indicated that President Trump has also been considering a much broader 20% tariff that could be applied to almost all of America's trading partners or on the vast majority of imported goods, so essentially everything.
Wow.
Another possibility that's been floated is a more general across-the-board tariff on a set of countries, perhaps at a lower rate than that 20% figure.
So a lot of possibilities on the table, but not a ton of clarity around the specifics. And this lack of clarity seems to be generating a significant amount of, anxiety and uncertainty in the markets.
Absolutely. As analysts at Nomura Holdings have pointed out, the absence of those concrete details regarding, the specifics of these tariffs, the exact rates which countries or goods will be targeted, has left both investors and governments feeling like they're flying blind as we await, this afternoon's announcement. And this uncertainty itself can have a real chilling effect on investment and business planning.
And what kind of potential impact on, the landscape of global trade are we looking at here, depending on how these tariffs are implemented?
Well, Bloomberg Economics has put out some pretty stark estimates.
Okay.
They suggest, depending on the scale and scope of the tariffs, some countries could see their exports to the United States plummet anywhere from a relatively modest 4% all the way up to a staggering 90%.
Wow, that's an enormous range.
Yeah, and that enormous range really underscores just how much hinges on the specifics of, Trump's announcement later today.
Yeah, potentially massive disruption to global supply chains. So what of the anticipated impact here at home on the U.S. economy?
Well, Goldman Sachs has recently revised their economic outlook,
Oh, okay.
now projecting a significant 15 percentage point increase in the average U.S. tariff rate this year as a result of these actions. They're warning that this could lead to higher inflation for American consumers, a slowdown in overall economic growth, and an increased probability of a recession. In fact, they've bumped up their recession probability forecast to 35%, up from their previous estimate of 20%.
So despite all this, potential for economic upheaval, reports in the Wall Street Journal are suggesting that the stock market has remained relatively calm in recent days. What might be behind this apparent disconnect?
Well, there are a few potential explanations. One is that investors might be cautiously optimistic, hoping that once the details of the tariffs are finally revealed, it will actually bring some clarity to the situation and reduce uncertainty, which markets generally dislike. Another possibility is that investors might believe that President Trump will ultimately stop short of implementing policies that would severely damage economic growth, perhaps due to concerns about, the upcoming election. And it's worth noting that while the S&P 500 is still down from its February high, it has experienced a bit of a rebound recently, suggesting some underlying resilience or perhaps a wait-and-see attitude.
It's always fascinating to watch the market try to anticipate, these kinds of these policy shifts and, the reverberations that could come from them.
Yeah.
What are some of the different underlying goals that might be driving these tariff proposals?
Well, the article suggests several potential objectives. One straightforward aim could be to generate additional revenue for the U.S. government through the collection of duties on imported goods. Another key goal could be to incentivize domestic production by making imported goods more expensive, thereby encouraging companies to, manufacture goods within the United States. And a third potential objective is to use the threat or implementation of tariffs as a negotiating tactic to extract trade concessions from other countries.
And it's important to remember here that the U.S. already has a number of tariffs in place, right? This isn't starting from a completely clean slate.
That's absolutely right. So we already have that 20% tariff on a wide range of goods imported from China, as well as a 25% tariff on certain steel and aluminum products globally, and tariffs on some goods from Mexico and Canada that were part of previous trade disputes. Furthermore, we have the scheduled implementation of a 25% tariff on non-U.S. made automobiles and certain auto parts looming on Thursday, although there's been some speculation about potential delays there.
So given this existing landscape of tariffs, what kinds of reactions might we anticipate from our trading partners once these new measures are announced?
Based on past experience, we could see a variety of responses. Some countries might choose to retaliate by imposing their own tariffs on goods imported from the United States, potentially leading to a tit-for-tat trade war. Others might attempt to negotiate specific exclusions from the U.S. tariffs for their products, and in some cases, as we've seen with countries like Vietnam, there might be promises to increase purchases of American goods in an effort to reduce their trade surplus and potentially avoid those tariffs.
And the Bloomberg article covering the potential tariff rollout also touched on the performance of the U.S. stock market in the first quarter of this year. What were the key takeaways from that?
Yeah, so the first quarter actually marked the worst performance for U.S. stocks since 2023, which is interesting given the generally positive sentiment we've seen more recently. Meanwhile, many other major markets around the world actually experienced gains during that same period, and notably, U.S. Treasury bonds and gold both saw increases in value, likely reflecting investors seeking safer assets amidst the growing economic and policy uncertainty.
And what are some of the main concerns that American companies are voicing in response to these potential new tariffs?
So a primary concern for many U.S. businesses is the potential for significantly higher costs for imported components and raw materials that they rely on in their production processes.
Okay.
And this could squeeze their profit margins and potentially lead to higher prices for consumers. There's also the possibility that foreign companies facing these new tariffs on their exports to the U.S. might decide to shift their production facilities to the United States to avoid the duties altogether, which could have implications for domestic employment and supply chains.
Right. Okay. A lot of potential domino effects from these impending tariff announcements. Let's pivot now to some of the other key financial headlines that have caught our attention. First up, Goldman Sachs has revised its forecast for Treasury yields, as reported by MarketWatch.
Yeah, so the strategists at Goldman Sachs, citing their expectation of a more severe tariff baseline as a significant factor, have lowered their year-end forecasts for both the 2-year and the 10-year U.S. Treasury yields. They now project a 2-year yield to finish the year at 3.3%, down from their previous forecast of 3.95%, and the benchmark 10-year yield to end the year at 4%, decreased from their earlier 4.35% prediction.
So what's the underlying rationale for this more dovish outlook on where Treasury yields are headed?
Well, their analysis suggests that the implementation of these higher tariffs will likely lead to increased inflationary pressures in the economy, potentially pushing the core PCE price index, which is a key inflation measure watched by the Federal Reserve, up to 3.5% year over year. However, they also anticipate that these tariffs will act as a drag on overall economic growth. So this combination of higher inflation and slower growth, in their view, will prompt the Federal Reserve to begin cutting interest rates with 3 consecutive quarter-point rate cuts starting as early as July.
Interesting to see how these potential trade policy changes are rippling through, macroeconomic forecasts, now shifting gears quite dramatically here. MarketWatch also had a fascinating report on the initial public offering of Newsmax that certainly generated a lot of buzz.
Absolutely. The Newsmax IPO was described by some as historic due to the sheer magnitude of the stock price surge in its initial days of trading. So after its shares were priced at $10 apiece, the stock price skyrocketed by over 2,230% in just the first 2 trading days.
Wow.
This incredible rally briefly pushed Newsmax's market capitalization to a level exceeding that of the much larger and more established Fox Corporation.
That's a truly staggering gain for a newly public company. But the MarketWatch article also pointed out some pretty significant concerns about the sustainability of that valuation, right?
Yeah, that's a crucial point. So the article highlighted that Newsmax's market capitalization at its peak of over $32 billion appeared extremely elevated when compared to its trailing 12-month sales, which were reported to be only around $156 million. In fact, its sales were significantly lower than even the S&P 500 company with the absolute lowest sales. So unsurprisingly, following this initial burst of enthusiasm, the stock experienced a substantial decline in pre-market trading, suggesting that the market was beginning to reassess its fundamental value. It serves as a potent reminder of how quickly investor sentiment can shift, especially with, newly listed, highly volatile stocks.
Yeah, definitely sounds like a case where, initial excitement might have outrun the underlying business fundamentals there. Let's move on to another interesting development reported by the Wall Street Journal. Visa's reported offer to take over the Apple Card network.
Yeah, this is a really intriguing situation unfolding in the world of consumer finance. So Visa has reportedly made an offer to Apple in the ballpark of $100 million to take over the network operations for the Apple Card, which is currently run by MasterCard. And this potential switch is coming about because Goldman Sachs, the current issuing bank behind the Apple Card, has publicly stated its intention to exit the consumer lending business, effectively putting the popular and valuable Apple Card program up for grabs.
And it sounds like there's quite a bit of intense competition among the major payment networks to secure this deal.
Absolutely.
Wow.
So Visa, American Express, and MasterCard are all said to be fiercely vying for this partnership. American Express is even reportedly exploring a scenario where they would act as both the issuing bank and the network for the card. The Apple Card is a highly coveted prize due to the significant purchase volume it generates, and Apple's increasingly influential role in the broader consumer finance ecosystem. So winning this co-branded card program would be a major coup for any of these networks.
Finally, let's touch on the recent news surrounding Intel's new CEO, Lip-Bu Tan, as covered by MarketWatch. What were the initial reactions and key messages from his first public appearance in the role?
Yeah, so following his first public speech since taking the helm as CEO, Intel's stock price actually saw a slight dip, likely because he didn't announce any immediate sweeping solutions to the company's ongoing challenges. However, the reaction from industry analysts seemed to be generally positive regarding his overall approach and tone.
Okay.
He was widely praised for his humbler approach compared to his predecessor, his emphasis on fostering a stronger company culture, and his direct appeal for feedback from Intel's customers, even if that feedback is critical.
Sounds like a deliberate shift in communication style.
That's certainly the prevailing sentiment. One analyst even described Tan's message as the most constructive they had heard from Intel in a long time, particularly highlighting his focus on rebuilding the company's internal culture as a foundational step. There was also encouragement around his stated commitment to working closely with the Trump administration on efforts to boost domestic chip manufacturing and his openness to exploring potential manufacturing partnerships.
And there's a particular phrase that an analyst used to describe Lip-Bu Tan's reputation in the industry wasn't there.
Yes, an analyst at Bernstein Research noted that Lip-Bu has a long-standing reputation for tending to underpromise and overdeliver.
Hmm.
And they felt that this more measured and realistic approach was a sensible and welcome change for Intel at this juncture, contrasting it with what they perceived as overly optimistic pronouncements from the previous CEO.
So a bit of a mixed bag for Intel. The stock price dipped a little, but analysts seem cautiously optimistic about the direction under the new leadership. Well, that brings us to the end of our in-depth exploration of these major financial headlines for today.
So just to quickly recap for you, we delved into the complexities surrounding investing in alternative assets based on BlackRock's recommendations and the intriguing findings of that NBER study on private equity fund size.
Right.
We then navigated the significant uncertainty introduced by President Trump's impending tariff announcements and considered their potential wide-ranging effects on both the global and domestic economies. We also examined Goldman Sachs' revised outlook for Treasury yields in light of these potential tariffs, the truly remarkable, albeit perhaps unsustainable surge in the Newsmax IPO, the intense competition among payment networks for that prestigious Apple Card business, and the initial reactions and cautious optimism surrounding Intel's new CEO.
This deep dive was designed to provide you with a more thorough understanding of these key financial stories making the rounds, and we hope to offer some valuable perspective on what they might mean for you and the broader financial markets. We'll see you all tomorrow morning with new headlines from major financial magazines.